Chapter 13 talks about the statement of cash flows. It's a very, very important financial statement. Um, it has a total of, the chapter has three objectives. We're going to focus on objective one today, um, which sort of gives you an understanding of that statement before we move it on to actually preparing and analyzing, which we'll do next class. So first of all, why is this financial statement existing, and what does it tell us? Well, just as the title indicates, um, the term cash flow simply means where the company is getting its cash and where the company is using it. Okay. And so the statement of cash flow simply is telling that story of where the company is obtaining cash and how it's using cash. So that's basically it. Um, but the statement tells us lots of useful information, um, such as, looking at past performance will help us understand how future cash flows will likely work. If we are a corporation that pays dividends, or we have debt payments coming up, well, we need to make sure that we have enough cash coming in to know whether we actually have the ability to do that, or not. We're going to be looking at cash flow as a slightly different than net income. Net income is the profit, as you know, after all the expenses are taken away from revenue. Um, However, not all the expenses that you hear about are actually cash expenses. Most expenses are. When you pay rent, you're paying cash. When you pay salaries and wages expense, you're paying cash. But not all expenses, believe it or not, are paid from cash. One notable one coming up. Um, we look at all the different operating activities of the business to see how we are saving cash or using cash. Okay. Then we look at the investing activities of the company, and we look at the financing activities of the company, because all of these activities, whether they're operating, investing, or financing, they're all involved in cash coming in or cash going out of the company. Okay. So here, this is important to sort of understand, right? Um, oops, sorry. When we're talking about the cash flow statement, we're talking about the three sections that we've talked a little bit about, right? Operating activities, which are almost always related to income statement items, because the largest part of operating activities is revenue and expenses. And then we have investing activities of the company. You might remember that companies will buy property, plant, and equipment, or um, they'll have investments, or they'll sell them. And so any changes in the investments or long-term assets are part of that investing activities. And of course, companies have, as you know, financing activities. Financing is that side of the balance sheet that includes liabilities and stockholders' equity. So any changes in those areas tend to be financing activities. So let's take a little bit of a deep dive into each. Okay. So first of all, when we look at operating activities, we, from a cash flow perspective, we're looking at cash going in, so that's cash inflow, and cash going out, so into the company, out of the company. So for the operating activities, how is cash coming in? Overwhelmingly, it's from selling your products or providing services and collecting cash from your customers. That's the biggest part of cash flow from operating activities, is that's how companies get most of their cash. However, companies can receive interest, and they can also receive dividends, and that is also part of cash coming in. Okay. Cash outflow really looks at the uses of cash related to operating activities. So they'll pay suppliers for inventory, right? So either that's going to be directly uh, supplies for cash, or if they put it on account, they're going to need to pay that. Employee wages paid in cash, that's cash going out. Um, Sending tax payments to the government, it's cash going out. Paying interest, paying lenders for interest, right? So that's also cash going out. And paying any other type of expenses tends to involve cash going out. So again, we're looking at cash flow from that perspective. What's coming in, what's going out, specifically for cash. So those are the operating activities that are involved. The investing activities, again, cash coming in, cash going out. You'll see that there's differences here. So every time they sell property, plant, and equipment, they're going to be collecting cash for the sale. The proceeds coming in are going to be cash. So that's an inflow. If they sell any investments that they might have, the company might own, that's going to be cash coming in. But when they lend money and they collect that money, that's also a lending activity. I think it's also an investing activity because their notes receivable is basically a lend. That's an investing activity. They've lent money for profit, for interest, and so collecting that on loans is also part of the cash inflow from an investing activity. Cash outflows, really very important. Are they purchasing property, plant, equipment? They usually would do so when they're expanding. It's one of my big things when I read a cash flow statement. I want to know what the company is buying, because oftentimes if they're planning to expand, that means revenue is going to be increasing and profits usually increase as well. So I look at what they're buying. Yeah, certainly buying investments. They might have stock investments or debt investments. Yeah, that's a cash flow activity from investing. But I don't know why it doesn't really help the company that much to purchase stock in other companies, because it doesn't directly relate to the sale of their goods or services, and that's really where their profit comes from. Cash outflows could also mean that they're making loans to other entities, and so that's also an investing activity. Lastly, the financing activities are really on the balance sheet on the liability and stockholders' equity side. And again, we're still looking at it from cash coming in or cash going out from these activities. So anytime they sell common stock, they're going to be collecting all that cash from the new owners. So cash coming in. Whenever they issue bonds or notes to investors, cash is coming in because the investors are giving them a loan. So that's an inflow of cash. Cash going out from financing activities means every time they pay stockholders dividends, that's a financing activity because it affects stockholders. Anytime they pay back their debt, long-term debt, that's usually a financing activity because it's cash going out. Okay. Same thing when they buy their own stock, treasury stock. Remember that from Accounting 104. That's another financing activity, but that's going out because the cash is going out to buy the shares of stock. Okay. One of the other things you have to consider here is there's a lot of business activities that happen that don't involve cash. Okay. They're called non-cash activities, and here are a few that are listed. Sometimes in order to buy an asset, maybe a building, maybe a piece of equipment, they might actually issue common stock to pay for that. instead of cash. So if they issue common stock to purchase, say, a building or another company for that matter, it's non-cash. Cash is not involved. It's simply stock for assets. When they have convertible bonds, you probably remember chapter 10 back in Accounting 104, we talked about bonds and convertible bonds. Well, what happens when you convert bonds into common stock? Because that's what a convertible bond allows the bondholder to do. That's a non-cash transaction. Usually the bondholders would be paid back in cash. In this case, the bondholders are not paid in cash. They're paid in shares of common stock, which doesn't cost the company cash. If they issue bonds to buy assets, that's a non-cash activity as well. And if they simply exchange plant assets, that's a non-cash, one asset for the other. Okay. So normally speaking, companies need to report all this. They do so either at the bottom of the statement, cash flow statement, or they'll most likely what they do is they go to the notes to financial statements and they have a separate note showing and explaining their non-cash activities. Okay. So this is sort of the crux of of understanding this part of cash flow. We have all learned through the last couple of classes, Accounting 104, Accounting 204, Accounting 104 particularly. You've learned how to do accrual basis accounting. Okay. And so that's very important to understand. However, when we talk about cash flow and the statement of cash flow, we're actually looking at cash basis. And so one of the things that you're going to be learning here in this part of the chapter is sort of understanding that even though a company is going to report a certain net income, that's not necessarily the same as the cash that actually was provided by those operating activities, which are usually on the income statement. There's differences. And that's because net income would subtract out depreciation expense, for example. But in reality, depreciation expense, you don't write a check for. So that cash never leaves the building, so to speak. It stays in your account. And so net income is going to be slightly different than the net cash by operating activity because this net cash will assume certain cash payments are not happening. Whereas the net income, like I said, in the case of depreciation expense, they're assumed that actually was money going out, which is not the result. Okay. So that's what this is sort of kind of getting at here. Okay. Next week, or next class, we're actually going to be preparing a statement of cash flow. The most popular way in which we do that is what you're going to be learning is the indirect method of doing so. But there's certainly, when you look at a statement of cash flow, you'll see a certain order. Operating activities are always listed first. Investing activities are always listed second. Financing activities are listed third, followed by the change in the amount of cash. Okay. So when you look at any statement, and this is a statement, this is on page 554. So if you're in your book, this is page 554. What you're going to see is a cash flow statement is going to start with the cash flow from operating activities. Okay. We're going to be getting into those individual items in detail next class, which is why I think this is a good introduction, because it just introduces you without overwhelming you with some detail. I'll do that next time. In most cases, the cash flow from operating activities is going to be providing cash flow to the company. It will not be using up any cash. If a company is using cash just to run its operations, that's not usually a good sign. There might be reasons for it, but in general, it's not a good sign. The second thing that's listed is all the cash flow happening from the investing activities. And again, cash flow is listed, again, cash coming in, cash going out. Again, what happens to the cash for investing activities? You're either going to get more cash coming in than out, which is cash provided, or you're going to have more cash going out than in, which is cash used. Okay. And so I personally like to see, when I look at investing activities, that the company is actually using up cash here because they're investing in assets to help sell more of their products or services. They're expanding. So hopefully that's what it tells in terms of a story. And that third part is all the financing activities, right? All the inflows and outflows dealing with long-term debt, stockholders' equity type of stuff. Okay, and this can go either way. The net cash could come in to the more inflow than outflow, so it's cash provided. If it's more outflow than inflow, then it's cash used from these activities. These are all separate activities that are listed. The totals are listed to the far right side of the statement, showing the totals from each. If it's a positive number listed here, it simply means that there's cash provided from this activity or these activities, because there's a lot of activities. If it's a negative number, which is usually in parentheses here, it simply means that there's more cash that's been used, more cash going out than coming in for that activity. Okay. The result is going to be either, when you look at these three numbers together, you're either going to have cash coming in or cash going out. So there's going to be an increase or decrease in cash when you compare these three numbers. Okay. So the increase or decrease in cash is simply going to be added to the cash the company started with at the beginning of the year. That would be on the balance sheet at the beginning period. And those two added together is the ending cash, which you'll see on the balance sheet at the end of the period. And that is a cash flow statement. Again, as you saw earlier for the non-cash activities, it's either noted here on the statement, or more than likely, it's going to be in the notes. It's going to be in the notes to financial statements. And there you have it. Our review of Objective 1 is said and done, but let's review this because it's important to know how to classify your cash flow. And again, it's either going to be an operating activity, or an investing activity, or a financing activity. How you see these are operating activities are overwhelmingly income statement based. So it's going to be overwhelmingly revenue and expense based. Investing activities are almost always related to your assets. Okay. And your financing activities are going to be mostly related to your liabilities and stockholders' equity. Mm-hmm. So if you look at this one, we issued 100 shares of stock, 100,000 shares of stock, thank you, for $800,000 cash. So when you issue shares, you sell them. And if you're selling them, you know that money is coming in, and that's a financing activity because it's coming in from stock. Common stock is stockholders' equity. That's a finance activity. Here, you borrowed a lot of money, $200,000 from Castle Bank, signing a 5-year note. Well, again, this is a liability, right? It's a long-term liability, so that's also going to be financing. Here, you purchased 2 semi-trailer trucks. So semi-trailer trucks would be considered property, plant, and equipment. It's a long-term asset. And so when you purchase this should be considered an investing activity. You're buying more assets. Maybe they need that to deliver, and that's how they make a living. You paid your employees 12,000 of salaries and wages. Again, when you pay employees, it's an expense, and expenses are generally considered operating activities. And the last thing here is you collected cash from services performed. Services performed is your revenue, and revenue is also considered an operating activity. And that is learning objective 1. How'd you do? Questions? Straightforward?